Okay. So you can start giving your attendance in the message. So good evening, everyone. I'm going to start your
Good evening,
session
ma'am.
for today's good evening. Okay. So all of you, please write your names in the chat box so that later on we can download your attendance. I can see only 2 names. Others also, please write your names.
Grace is not here.
Yeah, I cannot see.
Grace, I hope you're there.
Yes, I am. Yes, I am.
Yes, Grace is there. Okay, so I hope everyone has written down your names.
Yes, ma'am.
Okay. So once again, good evening, everyone. We are going to start the session for your second semester financial management subject. And I hope everyone knows the code of this is 014. All of you have the content. You have the study material with you.
Yes, yeah.
Yes, we have, ma'am.
Okay. So again, we are through accounting and finance, and we know the basic terms and how accounting and finance is related with business and why we are studying it in the management. But again, when we come to our this second semester topic or subject, that is financial management, here it is directly linked with your specialization subject as finance. From here, when you are in second semester, you decide what you are going to take as a specialization in the coming semesters. So if we start with our subject, that is financial management, it is all related to management of funds. Finance is not money but management of funds. So there is a lot of difference between money and funds. When we talk about money, money is the currency, the medium of exchange. But when we talk about funds, we talk about finance. There is a basic understanding, and the understanding is that there should be a movement of fund. If we keep funds within ourselves and we do not use that fund, there is no inflow and outflow of that fund. The fund is said to be dead. The money is dead. So we need to have a movement. We need to have a push factor in that fund, and then it is how we manage our finance. When we talk about managing the finance, it is the best possible way we can manage it. Of course, when we talk about the best possible way, it means that funds has to be managed in such a manner that we are able to get maximum returns. Now, when we talk about maximum returns is in context with your cost. We all know what is cost of capital. Cost of capital is the term used for any amount, any expenditure paid for acquisition of funds. Acquisition of fund means for raising of finance. All the companies need fund, they need finance. The companies, they don't have enough or sufficient fund to manage their business activities. So in order to run the business activities efficiently, to carry on the production process, and to manage their operational activities, they require funds. And these funds are being raised either from the market through the issue of shares, or they are being taken as a loan from different financial institutions, commercial banks, or raised through public deposits. Now, when we raise the funds, we have to pay certain cost. The cost may be in the form of interest, the cost may be in the form of dividend. So, when we raise funds and when we have to pay cost of capital, we need to compare this cost with the returns that we have against the funds invested. The funds that you have raised, they are either to be used in your working capital, a very small portion, and then the next is to be kept for purchase of fixed assets or to be used in the long run. So when you compare your funds, your investment with your returns, and then the cost incurred on the acquisition of those funds, always remember maximization of returns is the objective of business. We need to have more and more returns compared to the cost of capital. So there is an equation: minimize the cost of capital and maximize the return on investment. As long as you are able to manage the cost of capital with the returns, your business will be having high profits. But on the contrary, if your returns are less and the acquisition cost is more, then there is no question of profit, because the cost is more and the returns that you are going to enjoy against the investments, against the deployment of funds, that is going to be very, very high. So, coming back to what we are going to study today, the first unit or first block, it is just an introduction to the subject. The introduction to the subject is financial management. And what is the objective of this first unit? To familiarize you with the scope and functions of financial management. First, we'll understand what is financial management, and then we will try to familiarize ourselves, develop an understanding about the scope and functions. The second one is try to understand the objectives of the business firm. When we talk about objectives of the business firm, it means that why we are doing business. What is the basic reason behind carrying out the business? The next objective or next what you are going to study is the major decisions of the finance function. Finance itself is an organization, and while managing the finance, what are the major decisions the business has to take? And the decisions which the business has to take is been taken by the finance manager. Describe the structure and organization of the finance department. This is the organization or structure of the finance department. Who is on the top? Who is assisting whom? So it is a flowchart of hierarchy. Who is on the top? Who is going to follow whose order? And how the department is constituted. So this is all about your first unit or first block or today's learning. Any one of you, be honest in answering. Have you gone through the contents or the topics that we have to study today? Just feel free to reply.
No, ma.
Okay. So again, as we know each other, we have been met in the first semester also. So it's my humble request that again, when you come tomorrow for the class, at least go through the topics that we are going to discuss, because it's not possible for us. It is only your counseling session and we have lot of things to discuss. So if you are not aware about the topic, about the contents, then I cannot start from the scratch. So at least what are the topics, and if any of the terminology of the topics is not clear, that we can discuss. Am I clear? So we will be starting with the
Yes.
yes,
Yes, ma'am.
as usual. Grace, very prompt. I hope all of you have given good exam, your first semester exam.
Yes,
Yeah,
ma'am. We
but
are waiting for the
went
results.
fine. Went fine.
Okay, so waiting for the result, isn't it?
Yes, ma'am.
Yes.
Yes.
Some. Yes.
Don't worry, you all have got good marks. Okay? Soon your result will be out. Don't worry. So I'm coming back to the topic. Shall I increase the font size?
A little bit, ma'am.
Okay. Is it visible
It is.
clearly now?
Yeah, at least there.
It is there. Visibility is there.
Yes, ma'am. Yeah.
Okay. Just okay. So the first object is already we have discussed. Yes. So when we talk about or we start with this, it is in one side. I don't know why it is coming like this. So here you can see we have to discuss almost 1.11. That is, we have to discuss 11 topics for today. So let us start with the first one, introduction. Introduction means to acquaint yourself with the subject and with the topic. So when we talk about financial management, we need to manage different activities in the organization. We need to manage different people in the organization. We need to sell different products and services that are manufactured by the organizations, and we need to make available the required financial resources for carrying out all this manufacturing and distribution activities. So all the activities, they are managed by few people in a small organization and by many people in large organization. We also need some specialized people in large organizations, those who are technically and professionally sound in their area. So when we talk about big business houses, the activities are divided into different functional areas, functional departments. Like when we talk about small business, then a single person or a group of person is responsible for each and every task of the organization. They will be going for production also, they will take care of purchase also, they will take care of sale also, distribution also, arranging for the transportation also, paying salary, maintaining accounts, all is maintained by a group of people. But when we talk about large organizations, each and every activity is divided into different functional departments. And suppose you can take the example of like production department, it will take care only of the production, only of the manufacturing of goods and services. If you take human resource department, they will be responsible to manage the human capital, all the HR policies, industrial relation, this will be managed by them. If it is a sales department, they are only responsible for managing the sales. So in this way, we have different departments, including the finance department, which is responsible to manage each and every financial aspect of the business. So when we talk about that, different groups of people perform different functions. So is with the financial management, that we have different departments and there are different decisions in the different departments. So each and every department is responsible to manage their own activities. They do not interfere into the activities of other department. So we all know that as blood is very important for our body. We cannot live without the movement, without the flow of blood. If the flow of blood stops in a body, then it is a breakdown of our whole system. In the same way, finance is treated as the lifeblood of any business. If finance is not there, if finance is missing in the activities of the business, then the business cannot prosper. So we need to have sufficient finance in the business to meet all our requirements. When we talk about meeting all our requirements, the requirements may be short term, the requirement may be for a long run. But for every business, finance is must. For few business, the requirement may be less, and for other business houses, the requirement may be at a large scale. But without finance, no business organization can function. So, in order to ensure the smooth operation of the business and to run the business activities properly, efficiently, we have to manage the finance part also very effectively. So, when we say that finance is so important, so do is the department also crucial in the organization. The finance department is an important component in every business enterprise. So, we are here to understand what is financial management and why it is important. How to understand the importance of financial management? This we can understand by understanding the fundamental areas of financial management. So we will start first with the nature of finance function. Though it is not mentioned in your introduction, but before I move to the nature of finance function, a very simple equation I need to give you. We are talking here about finance, and we say that finance is an important element that exists in the business houses, in the business enterprises. And it is very important to manage the finances of the business very properly. So when we talk about finance, finance is managing one's fund. When we talk about business enterprises, so finance is managing the funds of the business. Finance can be management of fund as an individual, it can be management of fund for the whole organization. So if we start with the nature of finance or finance function, how it performs. What is the function of finance? We are aiming to the following functions performed by finance. We all know that when we start a business, when we take a business activity, the objective is to make profit. Every business activity should be accompanied with an economic objective, and that objective is making profit. And for this objective only, we invest money in different forms. It may be the investment in asset, it may be purchase of some investment or investment in some other sources, so that we are able to generate more and more profits. And in this process of generating more and more profits, the finance function is aimed in the following decisions. The first function of finance is to determine the funds requirement. We have to raise money from the market. So while raising money from the market, raising funds from the market, while acquiring the finance from the market, we first need to find out what is the requirement, how much amount is required. That is a quantitative aspect of finance function. I hope you are understanding what I'm saying. Yes?
Yes, ma'am.
Yes,
So
ma'am.
we
Yes, ma'am.
good. At any point, if you feel that you should have to stop me, please let me know so that I can repeat that. So again, I'm saying the first function is to find out, to analyze, to determine the total amount of funds required. It is in terms of quantity, amount. The second one is to determine the assets to be acquired or fund deployment. Now you know how much fund is required, and you should also have the knowledge for investing that fund. Where we can invest that fund, whether to invest in the purchase of assets for further generation of profit, or we have some other objectives, other areas where the funds can be invested. The third objective is to determine the pattern of financing the assets. The pattern is the quality. Funds requirement is quantity and pattern is quality. Quality means what are the means, what are the sources through which the funds can be acquired. Pattern of financing the asset. Asset, if you need to purchase, we need to purchase it through finance. So, when we raise funds, what will be the sources of raising the funds? Are we going to raise it through the issue of shares, or we are going to take loan from the financial institutions or any of the commercial banks? So, this way we determine the quality. What will be the mixture of debt and equity? Equity is raising funds through owners fund, that is shares, and debt is borrowing money from any of the financial institution. So we need to understand what is the combination of raising funds using debt, and what will be the proportion or combination of raising funds using the debt as a source of finance. So we can say that when we talk about the finance function, it is a managerial activity. Managerial activity means we need to manage. How to manage? With the involvement of proper planning and control function. How it is proper planning and control function? Planning in the sense of determining the requirement, the investment, the sources, and all. So a lot of planning is required, and at the same time, when we raise the funds and we invest them, we have to control, we have to keep a check that are the funds that have been deployed or the funds that have been invested, are they going to fetch the same profit, the same percentage of return which we have anticipated? The expected returns, are they equal with the actual profit? So this is a very big task which includes planning and then control. So what is our objective? The objective is to have more and more profit in future, and with this objective we try to park the funds, invest the funds in the most profitable avenue or area. So when we discuss or we try to distinguish the finance function from other business activities or functions, it is very challenging. Challenging in the sense because we have to categorize these functions as routine function and managerial function. So routine function is what is receipts, what is payment, okay, how we are going to manage the receipts and payments, where to keep the cash. If you have more funds in the office, you have to keep deposit them in the bank, and if it is in the office, how you are going to manage it, what is the security at office. We have so many documents, financial documents, how we are going to put them into safe custody, who is going to manage those precious documents. We also need to understand how or what are the procedures for raising fund, and the important aspect, the documentation part, the report keeping part, report preparation and record keeping of our day-to-day operations. Next comes your managerial function. The managerial function is very important because it includes proper financial planning, the management, and then the execution of the planned activities. So managerial functions, they are specially related to raising of funds and then deployment of funds, raising of funds and their proper utilization in the business. So acquisition of fund is the first objective of business, and the second objective is the use of those funds in a most efficient manner. Am I clear? Raising the funds and use of funds in the most efficient manner. These are the two important finance function which is related to managerial function. So there are different core activities which the financial manager is actively engaged in the management of these activities. If we start with the next topic, that is approaches to finance function or approaches of financial management, again and again I repeat on saying financial management is management of funds. When we talk about management of funds, management of funds means the flow of funds. When we talk about flow of funds, it is the inflow and outflow of funds. So financial management, if we start studying, there is a definition according to James C. Horn, and he states that the financial management at a company aims to make the best investment, financing, and dividend decision. So what he states, financial management at a company, it aims to make the best investment. Why it is best investment? Because it has to be maximum so that the cost of capital is very less. Second, it is financing and dividend decision. When we talk about financing decision is raising of funds, and dividend decision is distribution of surplus. So when we will come to the later topic, the financial decisions which are taken in the business, in that we are going to study them specifically, what is investment decision, what is financing decision, and what is dividend decision. But before that, we need to find out the approaches to financial management. Approaches means the road, how we can go, how we have arrived to the today's financial management concept. There are two approaches, the traditional approach and the modern approach. Now, when we talk about traditional approach, the traditional approach states that the financial management, in this, the scope of study is only confined in raising the funds. Again, I repeat, traditional approach states that it is a field of study where the scope is only confined with raising of funds. So when we talk about traditional approach, finance is restricted only in obtaining funds to manage the financial requirements. That means the finance department, the financial manager, they are only responsible to make the availability of funds required. They are not concerned to distribute the fund. They are not concerned in the investment of the fund. They are not concerned in a comparison of the funds that they have raised. Are they going to fetch that much return or not? So this is not a part in traditional approach. The traditional approach is subjected only and only to the raising of funds. I hope you understood what it is.
Yes, ma'am.
Yes. So this approach had a lot of drawback because unless and until we know where the funds are to be invested, what is the return that we are going to get from the invested funds so that it can be compared with the cost of capital, the theory is not at all complete. So in the long run, we need to have a detailed report and analytical information about the placing of the funds also, about the investment of the funds also. So from here, the existence of modern approach came, and in the modern approach, we are not only considered about, we are not only concerned about raising the funds, but the vision of the finance manager is what will be the investment of the raised funds. So the financial manager is concerned with determining the size and nature of the technology for raising the funds, setting the business direction and growth, shaping the profitability of the business, and many other aspects which are related to the management of the business. So, here, because of different financial decisions, the impact is on the business activities. So we need to find out that how we are going to have maximum returns from the invested funds. So the modern financial managers, they must make the rational financial decisions. When we say that they must make the most rational financial decisions, it means that they should be very informed about the decisions that they are going to take, because the decisions that they are going to take is going to maximize the return from the financial resources or funds that are invested. So we need to have a high level of administrative ability and management talent in taking the decisions related to raising of funds and then investing those funds in some profitable areas. Coming to financial decisions, this is what I was talking about. Financial decisions are the decisions which a company takes. We all know what is net worth of a company. Net worth of a company is the value of the company. When we talk about the value of the company, it means that it is the difference between the market value of all the assets that you have and the minus the value of liabilities that we need to pay. So the balance, if you have any, if your assets are more compared to your liabilities, the balance is known as net worth in the business. So when a company's net worth rises, it means that it can be assumed that the company's value is increasing. I, I hope you understood. Net worth can rise when your liabilities are less, or else when your assets are more. I hope you understand this equation.
Yes, ma'am.
When
Yes,
your
ma'am.
net worth increases, okay. So when our net worth increases, when either our liabilities are less compared to our assets, or we have more assets compared to our liabilities. And when we have more assets, when the company is in profit. If more and more profits are incurred, it is resulting in more and more assets. And that is the reason why the value of the firm is determined on the basis of net worth the firm has. So when a company's net worth rises, we can say that the value of the firm is increasing. There are various factors which influence this value of the firm, and if you start broadly, they are divided into internal and external activities. Internal activities through which the value of the firm increases are investment activities, financing mix, and distribution of profits. And external factors that increase the value of the firm, it is the state of the economy, capital market conditions, and tax rates. So the internal conditions are within the control of the organization. If something is adverse, we can restructure our internal activities. But external activities, they are not within the control of the organization, because that is something which is related with the whole world. Whether it is the state of the economy, capital market conditions, that is market condition, or the tax rate which is decided by the government. So the organizations, the business enterprises, they do not have a say in this. So when we start, we are here concerned only about the internal conditions through which the value of the firm increases. The internal factors through which we have the ability to increase the value of the firm or increase the net worth of the firm. The first one is investment activities. Investment activities, it is a proper investment decision. Investment decision related to deployment of funds, how much returns are there, comparing the returns with the cost of capital. Next, it is financing mix. Financing mix is the combination of different sources of finance. I had explained you what are the different sources of finance. They are your equity and debt. We have different areas to invest. It can be invested in the share market, or we can raise the funds through long-term borrowings. So when we talk about financing mix, it means that the total capital of the firm is a sum total of different sources of funds. So which type of funds our company is going to raise for meeting the financial requirements? And the third one is distribution of profits. Distribution of profits is your dividend decision. Whenever the shareholders, they have profit, whenever the company have profit, and the profits are to be shared by the amongst the owners of the firm. Anything you want to say? Farida, you want to say something?
Oh, no, sorry,
Yes.
sorry. No, no, no.
Okay. So what we are saying, that when there is a profit, we all know profits are being shared by the owners of the firm. So when we have profits in the organization and the owners are the shareholders, then we need to distribute them the profits. The profits which are distributed to the shareholders, it is known as dividend. It is not necessary that we have to distribute all the profit. A part of profit can be retained within the organization for further usage. The part that is not distributed as profit to the shareholders is known as retained earnings. Earnings is your profit. So the part which is not distributed to the shareholders, they have been retained by the business, is known as retained profit. So what percentage of profit has to be distributed as dividend, and what percentage has to be kept for requirement in the form of retained earnings, this is an important decision. Again, when we talk about this dividend decision or distributing the profit, we need to understand what will be the ways in which we distribute the dividend. When we'll come to the last block, last unit, there we will study dividend decision, dividend, how dividend is distributed. It can be paid through cash, it can be paid in the form of shares, it can be also paid by assigning the asset of your firm. So these are the three decisions that the financial manager has to take on behalf of the financial management. There is one more decision which is not mentioned here. You may find it in many of the books, and that decision is your liquidity decision. Liquidity decision is the decision that the cash which is available with the firm for a short period of time, how to invest, how to manage those short-term cash. Liquidity means whenever required, whenever you need to pay your short-term liabilities, you should have enough cash with you for the management of your day-to-day activities. And if you're not able to manage your day-to-day activities, if you're not able to manage to pay your interest on capital on time, so this may again further land you to troubles. Your credit worthiness in the market may be destroyed. So, what is important? The internal factors in financial decision process. Am I clear?
Yes, ma'am.
Okay. So, you can see a equation here. All of you can see a equation. This is the equation which I am highlighting. Is it visible to you?
Yes, it's visible, ma'am.
Yes,
So,
yes, ma'am.
this equation is V equals to value of the firm. V is denoted as value of the firm, and value of the firm is the function. F is function of investment, financing, and dividend. Stands for investment, F stands for financing, and D stands for dividend. So, value of the firm is the function of how efficiently you are able to manage the investment decision, the financing decision, and the dividend decision. Am I clear? And each of these decisions that you can see, all the decisions, they are to be considered as very important goal of the business, and each and every decision has to be undertaken with the motive of maximum returns from each and every decision. Am I clear? How you can maximize the value? Value is value of the firm. Value of the firm is determined on the basis of the market value of equity shares. Whatever is the value of your shares in the market, that is the determinant factor of deciding the value of your firm. So how you can maximize the value of the firm? The value of the firm can be maximized if the market price of the shares is more in the stock exchange, in the market. I hope I'm able to make you understand the concept.
Yes, ma'am.
So these are the investment decisions. These are the bifurcation of what is investment decision. Investment decision is related to making an investment in long-term assets, investment in current assets, what will be the selection of the assets, how much fund you have to make investment, where to make investment. We need to understand the capital budgeting decision. Capital budgeting means it is a decision where we need to find out the returns that we are going to get against our investment. Sorry. So coming to next, after investment decision, we have the second one, liquidity decision. I have told you what is liquidity decision. It is the management of a company's short-term funds. And liquidity decision is the most important decision, because if you're not able to manage your current assets and current liabilities properly, it may lead to short-term solvency of the firm. Financing decision. The financing decision is related to the firm's finance mix. Finance mix is the decision what will be the proportion of your equity and debt in the capital structure. What will be the sources of funds? What will be the means through which the funds are raised? What will be the quantity of each finance mix? So the financial manager, he should determine the optimal capital structure. What is optimal capital structure? The capital structure which maximizes the shareholders' return, shareholders' wealth, and they want to minimize the risk. Risk should be minimized only in the case when you have to pay less cost of capital. And less cost of capital is paid when you have less depth in the business, because we need to pay interest. So if your interest is less in the business, you have employed less depth in the business, then you are at low risk. The next is dividend decision. I already told you what is dividend decision. It is the distribution of profit and retaining the profit which is non-distributable. So it depends on the firm's dividend policy, how much to distribute, when to distribute, and how much to retain. So this is all about your financial decision. Am I clear?
Yes, ma'am.
Yes, yes.
You can continue, ma'am.
Okay. So I'm coming to the next. If it is clear, objectives of firm. We all have a goal, we all have a path where we need to move. Same way, there are objectives of the firm also, objective of business also. The business should also know where to move, which path they have to follow. So when we talk about the path which the business has to follow, it has to be pre-decided. We are talking here about following the path. We can follow the path only when we know the path where we have to go. Same way, when we talk about objectives of the firm, objective of the firm means the goals of the firm, where the firm or where the business needs to move. So if we talk about the objectives of the firm, it is not much different from the objectives of the business. The objective of the business is to have more and more profit. Same way, when we talk about the objectives of the firm, it is also to have more and more profit. But how you are going to calculate that profit, it is on the basis of the returns. So when we talk about the objectives, there are two objectives of the firm. One is profit maximization and the other one is wealth maximization. Again, I repeat, first one is profit maximization and second it is wealth maximization. So when we start with the first one, profit maximization, I told you that what is the objective of the firm? The objective of the firm or the objective of the business is to have more and more profits. So when the business objective is to have more and more profits, so why should not it be the objective of the firm also? Why should it not be the objective of the financial management also? We should have maximum return so that we can enjoy the profits, so that the investment that we have made can fetch more and more returns. If we have more and more returns, then in that case, we will be able to make proper payment of dividends. We can pay our all other expenditures and so on. So when we talk about to meet these objectives logically, then there comes certain points of discussion. The points may be on the basis of agreement or disagreement. So if we talk about the first one, profit maximization, it is a objective, it is a thought where we say that we should have more and more profits. We know the business aims in maximizing the profit. So when the business aims in maximizing the profit, why should not we also have the profit maximization objective in the business? This is the first argument in favor given by the thinkers of profit maximization objective. Second, it is, we all know the measurement of the efficiency of a firm is based on the profit. If we compare two companies and the profit of one company is 100 crores and the profit of another company is 200 crores, as a rational investor, we will be investing in a company where the profit is 200 crores. So, profit is the measure of economic efficiency. We know the company which is having more profits will be in a position to make more payment of dividends, will be in a position to pay back our principal amount, and will not be in general into financial crisis. So the second point is again agreed. Coming to the third one, profit leads to the efficient allocation of resources. If you have profit, we can have all the resources allocated. And the last one, it is a very important and scarce resource. It is very difficult to raise funds from the market. So against your funds, if you are able to manage with more and more profits, that means the scarce resource that is available, you are making most efficient use of that scarce resource. So, as stated, the profit maximization should be the only objective of financial management decision. Whenever you take the financial management decision, your profit maximization should be on the top. Now we have certain limitations or drawbacks also of profit maximization. The first is ambiguity. When we talk about ambiguity, ambiguity means there is a confusion. Confusion, here we are talking about profit. So profit, when we talk, it is a very ambiguous situation, inaccurate situation, that what we actually perceive as a profit. Are we talking about long run profit, or we are talking about short run profit? Are we talking about total profit or only rate of profit? Are we talking about the profit which is available after tax, or the profit which is available before paying the tax? Are we talking only about return on equity? That means return of the shareholders, or we are talking about the return on total capital employed? Total capital employed means the total capital of the firm, which also includes debt. So this is an ambiguous situation, that when we talk about profit, actually which profit we are taking into consideration. So no clarity is given in this objective profit maximization, which profit has to be taken in consideration. So in the absence of a proper guidelines, there is always a dilemma that which profit the company is trying to maximize. Coming to the second one, the second limitation is that it ignores the timing of benefits. It ignores the timing of benefits means that we are not taking into account the time value of money. What is time value of money? That means if you invest today and you are not getting returns for 2 years, but in the next 3 years, your return is going to equal your investment. And a second case may be that the return may start getting from the first year, and again, it also takes to equalize your investment in the 5 years only. So you can very well understand from this chart, there are two alternatives of investment you can see, project A, project B, and how you are generating profit. For example, in project A, for the first year you earn 5,000, second year you earn 10,000, and third year you earn 15,000. So your total generation of profit is 30,000, and your investment is of, if you talk about average profit here, so it is this 30,000, it is raised in 3 years. So when you divide it by 3, your average profit is 10,000. I hope project A is clear. How you got average profit 10,000, is it clear?
Yes, ma'am.
Total 30,000 divided by number of years, that is 3. In the project B, in the first year, you see you are generating 15,000. And when you compare this with project A, in the first year it is generated only 5,000. So in the first year itself, you may be getting panic. How to maximize? I am getting only 5,000, whereas the other project is generating 15,000. In the second year, both the projects are getting 10,000. And in the third year, again, you see project B is not able to generate enough compared to project A, where it is generating 15,000. But when it comes to total, the total amount which it is generating through profit is 30,000. 30,000 is total cash inflow. And again, when you come to the average profit, divide this 30,000 by 3, the average profit is 10,000. So this is what we are talking, that we are not considering the time value of money. We are not considering the timing benefits. So project B is providing higher early returns, and the basic thing of financial planning is this only: earlier the better. We cannot wait for long years to get our principal back. So if you need to invest, you will be preferring to invest in project B, because the maximum amount that you can recover is from project B. In project B, you are able to recover 25,000 in the second year itself, and in project A, it is only 15,000. So according to the principle of time value, project B is preferable, because you are going to get back the maximum one within a period of 2 years only. So what we are talking is profit maximization. If you take, here also we are getting 30,000, here also we are getting 30,000. So this 30,000 is not taking into account the time value of money. It ignores the time value of money. It is only considered, yes, average is okay, total profit is okay, but they are not taking into consideration earlier the better principle. You understood this?
Yes, ma'am.
Yes, ma'am. Is understood, ma'am.
Good. Coming to the next, it ignores the quality of benefits. What is quality of benefits? Quality of benefits means that, again, two projects are there, and in the A project, during recession, you are pessimistic, you have 9,000, and in project B, it is only 0. You are not able to earn anything in the project B. In normal cases, you are able to earn 10,000 proper, and in the boom period, you are very optimistic. So in the project A, you are earning 11,000, and in project B, you are earning 20,000. So again, coming to average profit, you can see here it is 30, here also it is 30. So the average profit is 10,000. But what is important here is project A has higher quality earnings, because the range is very small. 11,000 minus 9,000 is 2,000. But project B has a larger range. That means from recession to boom period, recession you earn 9,000, and in boom period you earn 11,000. That means even during the recession period, you are having an income of only less 2,000, which you can earn in the boom period. But in project B, if it is a recession, you are not going to earn anything. Okay? And when it is a boom period, you are earning 20,000, but the difference is of 20,000. So from first period, that is the recession period, to the boom period, there is a difference of 10,000. So which one is much better? Looking into the difference of profit margin, the first project is better. Okay? Am I clear? Second, we do not take into consideration the earning per share. The profit maximization does not talk about expected returns, future earnings. and the financial risk. Coming to the wealth maximization. So, what is the alternative of this? It is wealth maximization. There is a, we say that the objectives of business should contain the following aspects. The objective should be precise, that means it should be very clear. It should consider both quality and quantity. It should be based on bigger the better principle, earlier the better principle, and it should recognize the time value of money. So these are the shortcomings of profit maximization, and wealth maximization objective has overcome all these criticisms. So, what is wealth maximization? Wealth maximization says that yes, we do agree, without profit, we cannot work. We need to have profit for the business, but that profit has to be the profit which we earn with minimum cost of capital. The profit which takes into account the time value of money, so that if we plan the profit of future, that profit is taken into account. If today we are earning 100 rupees and we are expecting to earn another 100 rupees after 5 years, so we know that the value of money is depreciating. So we have to consider that after 5 years that amount is going to be 80 rupees or 70 rupees. So if you take this into account, the time value of money will be totally considered. So, what is the implication of wealth maximization? Wealth is considered as the value of shares of an organization. What is the wealth of the shareholders? It is the value of shares, it is the amount of shares that the shareholders hold. So, how to increase the wealth? How to maximize the wealth? The wealth maximization concept says that if you are increasing the cash flows of your business, if you are increasing the dividend paying capacity of your business, if the demands are increased, then automatically your market will be very positive and the share value will be increased. So, the implication of wealth maximization is that wealth maximization is not only considering or concerned with the limited group, only the owners of the firm, but it aims in the prosperity and perpetuity, that is, continuity of the company. It helps in measuring the performance of the company. It also helps in allocation and reallocation of the scarce resources, that is, the financial resources. And it helps the company against the consumer protection, payment of fair wages, provision of safe working conditions, environmental protection, risk associated, and of course, the efficient use, the judicious use of the scarce resource. So, in keeping in view all these factors, we prefer to have wealth maximization in the organization. Wealth maximization is the better option in the organization. Am I clear till this? The objectives of profit maximization and wealth maximization.
Yes, ma'am.
Others also? Others also, can you respond?
Yes,
We are
quite,
clear.
quite, yeah, quite clear.
It's
Okay.
clear.
Just
Yes,
just 2
yes.
minutes. Okay, then we will again start. Just 2 minutes. Okay, can we start?
Yes, ma'am.
That's fine.
Yes, yes.
Okay. So we are coming to the next one, that is risk return trade off. Now, risk return trade off, risk is losing your money or not having return on your investment, and risk and and return is having return on your investment, having profit on your investment, able to manage your expected return and actual return. So when we talk about risk return trade off, return is the risk free rate plus risk premium. Return means, on one hand, you have a risk free rate plus it is a premium of risk that you take. It is an incentive of risk that you take. What is return? It is an incentive of risk that you take. So when we talk about risk free rate, it is the compensation for the time and investors part with their saving. You are contributing to the savings, you are contributing to the investment and waiting for a period of time. So it is the compensation against that, the return that you enjoy. Am I clear? So when we talk about the balance between return and risk, we need to optimize the market value of firm shares. A risk return trade off is a term used to describe, trade off is the balance, the equilibrium point. So, the risk return trade off is a term used to describe such a balance. How this balance can be described? You see, the objective of financial management is to maximize the value of shares. What is the objective of financial management? Maximization of value of shares. What is maximization of value of shares? Maximization of value of shares means that you are maximizing the wealth of the firm. The value of the shares can be maximized when you maximize the value of the shares. And how to maximize this value of shares? It is on the basis of the financial decisions that you take. Okay, so again I'm starting from the first. What is the objective of financial management? To maximize the value of shares. That means wealth maximization. And how to maximize the wealth of the firm? It is a very effective managerial decision which is taken on the basis of financial decision. So the value maximization is on the basis of investment decision, liquidity decision, financing decision, and dividend decision. If you are very much effective in taking all these four decisions, then you are able to maximize the value of the shares. So when we say that the financial decisions, it is a trade-off between risk and return. How it is a trade-off between risk and return? If your decisions go wrong, it is a risk. And if the decisions are very effective, efficient, taken in a proper planned manner, then you are going to enjoy the fruits of return. So we need to balance these decisions in such a manner that the risk and return is balanced. Even if there is a risk, the return that you are going to get from other investments, if they are put in proper way, managed in a proper way, there is a balancing. So this is what is risk return trade-off. And we know that we don't need to invest in such areas where the risk is more. Because if we aim at more and more returns, then we have to invest in more and more risk investments. So more return more risk, more return, and less risk, less return. So we need to trade off, we need to balance somewhere between these two equations, that how to manage the risk along with the returns in the organization. Coming to the next topic, it is the financial goals and firm's objective. We have already mentioned what is the financial goal. The financial goal of the business is to maximize the shareholders' wealth. How to maximize the shareholders' wealth? The primary goal of business is not to maximize the shareholders' wealth, but it is also to the survival and future growth. We need to maximize the firm's wealth at a point, but at the same time, we have to think about the survival of the firm, about the future growth of the firm. And we need to satisfy this with our investors, because no investor is going to invest in a firm where the future is uncertain. So, in order to have a stable future, we need to provide with high quality goods and services, so that the demand of the products is very high and we are in a position to make production and supply fulfill the required demands. In addition, organizations are in practice to define their mission and vision also. The mission and vision may be in terms of technology, it may be in terms of leadership, market share, image, employee welfare, and so on. So, the mission and vision, it is the structure of the organization. It states, it makes you understand the way the organization is going to function. What are the leadership qualities the organization have? What are the strategies? What image, what goodwill it shares? And important aspect, how it is going to deal with the employees of the organization. So, as a result, the company bases its strategy on the fundamental goals of technology, production, purchasing, marketing, and finance. And for making these strategies, the company needs to take decisions which are lined up with the objectives of the firm, with the mission vision of the firm. So, wealth maximization comes at the second level. The first level is the economic performance at minimal norm, at low cost. So, when we talk about the management, it is an agent also, an owners also, and a trustee also for other stakeholders. It is a agent for the owners because they are providing them with the maximum benefits. They are trustee for the stakeholders because they ensure that their investment is in the safe hands. So, as a result, the management must balance the interest of the owners along with the other stakeholders of the organization. The balance between the owners and the other stakeholders. Who are the other stakeholders? It is the creditors, employees, government, society, and so on. If you do not balance, then, and if you go only with the objective of wealth maximization, which is actually increasing the value of the shares, then there will be a stiff among the other stakeholders. They will start thinking that only management is concerned about maximizing the owner's wealth. They're not concerned with maximization and providing benefits to other stakeholders also. And there may be a stiff. The creditors, the employees, they may feel rejected. And that is the reason why we need to focus on the stability of the organization, on the future growth of the organization, and most important, the survival of the organization. So it is not only the maximization of the shareholders' wealth, but it is also the maximization of the interest of other stakeholders who are all associated with the organization. Coming to next, it is conflict of goals, management versus owners. What I said just now, it is the same. Management may not behave in the best interest of the shareholders when making decisions. They might pursue their interest, job security, and so on. In other words, when we talk about the conflicts between the shareholders' goals of wealth maximization and the actual aim followed by the management of the firm. So, the separation of ownership and control roles in the organization are defined as the key conflicting situation. Management may think that with our efficiency, with our strategy, we are not maximizing our own stake, but we are maximizing the shareholders' wealth. So, while pursuing the management's interest is unlikely because there is a continuous scrutiny by owners, employers, creditors, and other stakeholders. They evaluate the managerial performance, and the management survival will be against the organization aims. It will not be meeting the organization goals. So the wealth maximization criteria could be aligned with the interest of the organization stakeholders. The beneficiaries, each and every beneficiary who are directly or indirectly associated with the organization. Coming to the organization structure of finance function, the organization structure of finance function is this. We have a board of directors. This is a flow chart, how it functions. We have a board of directors at the top level. Then it is managed by a management. The elected members from the board of directors become a part of the management, and then they run the whole show. The management may have different officials, authorities placed in different departments. They can be production director, production manager, personal director, personal manager, personal director who takes care of the human resource management, then financial director, the authority of the finance department, and the marketing director who is responsible for taking care of sales and distribution. So this way, each department may have their own authority. When we talk about financial director, as we are only concerned about the finance part, under financial director, we have treasurer who manages the funds, maintains the funds, and documents the funds. We have a controller also. So if you go with the functions of treasurer and controller, then you can see the function of treasurer is auditing, credit management, cost control, and retirement benefits. So treasury is there for all the documentation work. The auditing is the management of the records. The records are being properly managed or not. It has to be audited. Whether you are able to keep, whether you are able to manage with the funds properly or not. Credit management is from where to raise money, when to pay back their money, what will be the rate of interest in which money is raised, funds are raised from the market. Retirement benefits is of course related with the employees. What will be the retirement benefits? What will be the social benefits provided to them after their retirement? It may include pensions, it may include their accumulated funds, it may include the amount that they're going to receive in the form of a provident fund and gratuity. What extra benefits they're going to get along with their regular retirement benefits. And the next area of control is cost control. When we talk about cost control, the treasurer is also responsible for minimizing the cost of the organization. The cost can be minimized by raising funds through the sources where we have to pay less as a cost of capital. We can also find ways through which the cost per product, the cost per production, the total cost incurred in production is less. If the cost per unit produced is less, then we can sell them at higher prices and the difference is going to be your higher profits. Coming to the controller roles and their functions, controller, it is planning and building. First they plan and then they build their strategies on the basis of those plans. It is inventory management. Inventory is what? Inventory is stock, proper stock management. When we talk about the firms who are mostly engaged in production, manufacturing process, their inventory management is an integral part of the overall management, because the whole process, your profit, your cost control, your wastage, keeping the record of finished goods, semi-finished goods, work in progress, how to manage with the goods produced, how to maintain them, where to keep them, maintenance of warehouses, godowns, management of warehouses, godowns. This all requires a proper strategy and planning. Then it is performance evaluation. Performance evaluation is nothing but evaluating the performance of the employees. Performance evaluation is evaluating the performance of the business. When we talk about performance evaluation, evaluation means mapping it with expected and actual. What you are expected to do, how you are expected to perform, and what actually has been performed. Am I clear? And the last is accounting. Of course, accounting, all the records, all the documentations, it requires accounting. So, this is the organization structure or finance function, which is depicted through the flowchart. Do you have anything to say till this?
No, ma'am.
Am I able to make you people understand?
Yes, ma'am.
Yes,
We are.
ma'am. Yes, we understood, ma'am.
Okay.
Yes.
Yes, Grace?
I just concur with the rest of the team. I'm able to follow.
Okay. Thank you, Grace.
Yes, ma'am.
Now I can see 2-3 people have joined late, because initially when started it was 12. So in case if you have missed your attendance, please put it in the chat box so that Smriti ma'am can download it later on. If you have not posted your names in the chat box as a attendance, kindly do it. Okay. So now, after the organization for finance function, we come to the next structure, and next structure is organization for finance function in a multi-divisional Indian company, or you can say, if it is not related to Indian company, multi-divisional company is the problem. Okay, so here we have board of directors, and then we have president, vice president, who are being nominated or elected amongst the board of directors only. Under the vice president, we have chief internal auditor, controller of accounts, financial controller, controller operations, and under each controller, we have different people, which is reflected through boxes. So this is about your multi-divisional organizational structure. Now this is important. Whatever we are studying, whether it is related to financial decision, whether it is related to finance function, whether it is the nature of the financial management, objectives of the financial management, approaches of financial management. All these functions, activities, tasks cannot be performed by the company itself. It cannot be performed by the financial management itself. Financial management is a process of raising the funds and making efficient use of the raised funds. So when we talk about raising the funds and proper allocation of the raised funds, utilization of the raised funds, it means that there has to be someone who will act on behalf of the company or on behalf of the financial management. So this role is being played by the financial manager. He is responsible to perform all the duties and functions which are meant to be performed by a company in financial management. So, these are the role of a financial manager, or these are the functions of a financial manager. So, any decision that is undertaken in the economy, in the business related to finance is being taken by financial manager. He is not only taking the decisions, but he also takes care of its implementation, execution, and then controlling. Controlling is a very integral part of the function of financial manager, because from controlling only we can conclude whether the project, whether the task is profitable or not. If we do not control the activities of the business in a proper manner, this may lead to loss of our money, risk investment in risky project, or we are not able to manage our returns with the cost. So when we start with the roles or functions of financial manager, the first one is to estimate capital requirements for various projects and offers to find for them. So first is related to your financing decision. And what is financing decision? Financing decision is to estimate capital requirement. Capital requirement means here we are talking about the quantitative aspect, which we have also discussed earlier. Quantitative aspect means how much amount you require for various projects and offers to fund for them. Offers to fund means the various options available to fund the projects. The second function is to maintain liquidity and solvency to fulfill short-term and long-term obligation. That means it is a liquidity decision, short-term solvency and long-term solvency decision. So to maintain liquidity and solvency. Solvency is continuation of the business. The business is carried on for a longer period. So to maintain liquidity and solvency, so that short-term and long-term requirement of funds can be maintained and you are able to meet the obligation. Obligation means your liabilities. Why we need to have a proper management of short-term and long-term funds, so that at times when we need to pay out, we have proper cash, proper funds with us. So this is, we talk about liquidity. If we are not able to manage a short-term or long-term obligations properly, it will be a big question mark to the credit worthiness of the company. It will be a big question mark which may lead to the deterioration or fall in the value of goodwill. There may be worse situation also, that if continuously you are not able to meet your short-term obligations, you are not able to make payment to your creditors, interest on capital, and so on, this may create a bad impression in the market that you are not paying the amounts properly against the credit purchase. So further, when you will be requiring money from the market to meet out your short-term obligations, the market may deny you. Why they will deny? Because they know that there is a loss of goodwill and creditworthiness of the particular firm in the market, as they are not able to meet their working capital requirement properly. They are not able to pay the amounts which they have raised from the market for a shorter period of time. So this way, management of liquidity is very important along with the solvency. And in continuation, if your mismanagement or absence of liquidity continues for a longer period, this may lead to solvency of the firm. The third one, to keep in control with the stock exchanges, stockholders, bankers, and financial institutions. So this is the licensing role, PRO-ship, how to maintain networking with the stock exchange. They need to contact the stock exchanges for listing their shares, for information regarding the upcoming issue of shares. Stockholders, the investors, they need to also have a linkage, proper communication with bankers and financial institutions. So, at times when you require funds, the bankers, the financial institutions can come forward to help you with financial resources. You also need to have stock exchange, a proper contact with the stock exchanges, because it is the stock exchange which is going to list the value of the shares. It is the stock exchange which is going to show the performance of a particular share issued from our company. So we need to have a proper networking with bankers, financial institutions, government, and stock exchange. The next one is, we need to estimate the risk and propose alternative risk education strategies. So I told you risk is something which is indispensable. Okay, we need, risk is always associated with return. So when we talk about return, at the same time we also talk about risk. So when risk and return, they walk hand in hand, so we need to have alternative arrangements, alternative strategies which can minimize the risk. So we need to estimate the risk, and we need to propose, make measures, keep measures in advance, that how we are going to minimize this risk. We also need to take established practices into account while deciding on credit policy. Credit policy means it is a policy which decides, when you make credit sales, then you need to have a policy related to what will be the maximum period of recovery, for how much period you are allowing the debtors to have credit, what will be the mode and way in which your money has to be repaid, the credit sale has to be repaid. If there is any lacuna in payment, if there is any delay in making the payment, then to put certain clause, financial, it can be recovery of some financial terms, it can be recovery of some amount as compensation of loss. Coming to next, to report to external agencies. Who are the external agencies? The tax authorities, government, financial institutions, about the performance of the company, about the audited balance sheet of the company. We also need to understand the role of financial manager is to meet several other duties which they have to perform related to legal aspects of the firm, related to tax laws, related to the different regulatory authorities, financial regulatory authorities like SEBI, IRDA, RBI, etc. We also need to arrange for an internal audit to be carried out to ensure that suitable checks and controls are in place. When we talk about the books of accounts, the accounting records, the movement of funds, the proper record of sales, and so on. We need to have a third person who is going to check all this in the correct manner. The process of checking all your books of accounts and following or complying with the rules is known as auditing. So we need to appoint an auditor also who can ensure that proper checks and controls are practiced in the organization. We need to decide the dividend policy of the company. This is again, though it is a managerial decision, management takes this decision, but on behalf of management, the financial manager has to play this role, implement and execute the dividend policy. So what are the parameters, factors on the basis of which the dividend policy can be taken, that it can be executed, is taken care by the financial manager. So all of the duties or functions that is mentioned, the responsibilities, they're expected to be carried out by the financial manager, and it should be within the limits of the legislation. The role should not be illegal, and what is more important, the objective is to maximize the shareholders' wealth. So all the functions that the financial manager performs, it is in compliance with the roles, functions, and duties that is mentioned. And this is the last topic, finance and related disciplines. When we study finance, it is related with all other disciplines. The first is finance and accounting. Finance and accounting, you had this in the first year's group paper only, which I taught you. When we talk about finance and accounting, it is closely related to the extent that accounting is an important input in financial decision making. We have to take financial decision related to the outcome of the accounting work. If the outcome of the accounting work is profit, then we can take numerous decisions. If it is loss, then also we need to have strategies how to overcome the loss and how to bounce back. Accounting is a crucial component of the financial function. The financial statements that we generate at the end of the financial year, that is the actual data on the basis of which we analyze each and every financial aspect of the organization. The information that is provided in these statements, they are being thoroughly checked, understood, and most important, analyzed by the financial managers. These statements are used in evaluating the firm's previous performance and compared with their current performance. So, in order to fulfill certain obligations and fulfilling certain decisions, we need to have a proper understanding about the financial statements. The following are the points on the basis of which we can decide the differences between finance and accounting. The first is treatment of funds. In accounting, we go with the measurement of funds. We recognize the origin of funds. We record the source of funds. But when we talk about finance, in finance, we are only concerned about the treatment of the funds. We are only concerned about the funds that are generated, the cash inflows, how we are going to treat those cash inflows. It means that in accounting, revenue is recognized only when received or paid in cash. Decision making, accounting is considered with the collecting of financial data, and the information which is provided in by the financial manager is related to financial decisions. So when we talk about accounting decision, No accounting decision, the rules, the guidelines of accounting are to be taken care by the financial manager. They have a separate department, accounting department, who is going to gather information related to that. Economics and finance. Finance is directly related to economics also, because the economic theories related to money and money supply is the base of your finance study. How to manage the working capital, investment decision, what is going to be the relationship, the equations given in the relationship of finance and accounting is directly related with economics. And so this is the summary of what we have studied today. We are focused in financial management. When we talk about financial management is related to the study of business finance, individual finance, and government finance. So, individual finance is financing oneself, like how to manage our salaries, our wages, and so on. When we talk about individual finance, it is the management of finance of sole proprietorship form of organization. When we talk about government finance, the finance inflows and outflow of fund which is managed by the government organizations. And business finance, the finance which is related to the company form of organization, the finance which is related to the industries and companies. And our subject matter of study is not individual finance or government finance. Here we are going to study only and only corporate finance, that is the finance of the business. Corporate finance, it solely focuses on the provision of finance for a business, and this finance is what we are going to study in the modern approach of financial management. What is the modern approach of financial management? It is raising of fund, distributing of fund, administering the fund, allocation of fund, and proper investment of fund. This is what we talk about modern financial management. That is the effective use of the raised fund with the focus on more and more wealth maximization. So profit maximization and wealth maximization goals, they go in hand. Without profit maximization, we cannot aim at wealth maximization. So this was the summary, the keywords. We know what is financial management. All the activities which are related to planning, controlling the financial resources, the generation of returns, the investment areas, avenues, and the achievement of the funds that are raised, the objectives are fulfilled, is your financial management. Profit maximization, of course, we know what it is. Wealth maximization, it is maximizing the value of the shares. Net present value is the present value of a rupee. Capital structure is the total capital, the form of capital which is used to raise the funds. When we talk about capital structure, it is the combination of your share, equity, and debt. Capital structure means how much the funds is to be raised through issue of shares and how much the fund is to be raised through debt finance. When we talk about capital structure, it is the mix of permanent long-term financing by debt, preferred stock, and common stock. Discounting is the factor, the reduction factor on the basis of future money is discounted. We compare the present value of money with the future value of money using the concept of time value of money, where we properly discount the value of money, discount the present value of money at a desired rate. So these are the questions. Your assignment, your examination will be based on these questions. you kindly go through all the questions and try to understand that whatever we have studied today, whatever we have understood today, are they going to match with our understanding? Are these questions going to match with our understanding or not? And if you find problem in understanding any of these questions, please feel free to write to me. We have our own account. You must be remembering. We have our official group that you all have created, or else we can discuss it in the next class. So for the day from my side, this is all. Now it's your turn. You can put your queries forward. We can discuss and then we can end the class for the day. So thank you from my side.
Thanks a lot, ma'am.
Thank you.
Thank you, ma'am.
Thank
Thank
you
you.
very much. I appreciate.
Thank you, Grace. I always admire
Thank
your
you. Thank you,
appreciation.
madam. Thank you. Thank you so much.
Thank you,
Thank you, ma'am.
Pura. I hope
Thank
you
you,
all
ma'am.
understood it today.
Thank you so
Yes, ma'am.
much.
Everything was clear.
Everything is clear. I hope you will be able to write your assignments based on the questions.
Yes, ma'am.
Yes, ma'am.
I was little slow today because this was the base of your understanding. This was the first block. So we need to be very much
Yeah.
familiar with the terminologies and all the concept. So when we move tomorrow to the next unit, we may be little fast.
Okay, ma'am.
All right,
Good.
ma'am.
Thank you.
Okay.
Okay.
Okay, ma'am.
So,
Thank you.
So can we end the class for the day?
Yeah,
Yes.
sure.
Right.
Yes, ma'am.
Thank you, ma'am. See you
yes.
later then.
Okay. Okay.
Yes,
Have
yes,
a
ma'am.
So
great day, ma'am.
great day. For us, it is night. Good night to
All right, all
everyone.
right. All
Good
right.
night.
It's
Good night.
good night. For
Good
us,
night.
it's 9:30 p.m.
All right, good night. Here in Nigeria is 4:54 p.m.
Oh my God, it's very good evening.
Yeah, good evening, ma'am. All right, good
Okay, I
night.
hope you people are all in your offices. So back to
Yeah.
work. Okay. Thank
Yeah,
Okay.
you very
Thank you,
much.
ma'am.
thank you,
Okay.
ma'am.
Thank
Yeah.
Thank
you.
you. Bye. Bye.
Bye. Bye. Bye. Bye, guys. Bye, nigga.